Hi, Winter. Thanks so much for joining me today. It's great to have you on the podcast. I'm looking forward to our conversation and digging into your experience and insights around the venture capital, especially when it comes to emerging managers.
Barack, thanks for having me on.
So, you have written extensively about raising the VC funds. What are the key steps for emerging managers should focus on in fundraising for their first fund?
Yeah, thank you. Thank you for the platform. Thank you for the opportunity to speak today. So I've written 2 books so far on the subject of building an investment firm. Both are targeted for emerging managers in their thought process and build process. The first is called How to Raise a Venture Capital Fund, and the second one is called How to Set Up a Venture Capital Fund. And they were written intentionally in that order because you have to raise a fund before you set it up, which may be an insight to some who haven't raised a fund before. It's kind of the concept of, don't build too much right before you ask your customer what they want. I think that's the same idea. So yeah, what is the process? Like if there are aspiring emerging managers in the audience, right? I'll talk about the first book, which is How to Raise a Venture Capital Fund. I think it really starts with, believing in yourself as an investor, really understanding yourself as an investor, and understanding, what your special sauce is that you can bring to the market and bring to founders. And if you're an early stage investor, right, bring to the early stage capital markets. So I think that is a self-reflection exercise, really understanding yourself and what you're doing and, how you're contributing to the ecosystem. And that's a really tough exercise for some people, right? To kind of take a step back and say, strategically, where do I fit in, right? How am I operating now? How do people perceive me? Like, where can I add value? And I think that's the first exercise that you have to go through to really understand, like, am I more a person that helps with product? Am I super technical? Am I more of a community person, right? Can I help founders in other ways functionally? Am I already a rock star in terms of track record? And so my go-to-market will be super easy when it comes to fundraising because all the institutions are going to like me already. I think you really have to ask yourself those questions in the beginning, and then you can, crawl, walk, run. You can hit the market a little bit faster once you ask those reflective, kind of self-pondering questions.
How should emerging managers determine the right fund size and structure?
Yeah, so it's sometimes harder in the beginning to really determine what your fund size is going to be, right? Especially if you're an emerging manager, maybe you have an aspiration to raise X dollars, but you only get to half X or 1/4 X, right? When you go through the fundraising process. But I do think there should be some, intention around what your strategy is in the beginning. So if step 1 is figuring out like who you are and where you sit in the market and what your value add and differentiation is going to be, then step 2 should be really like figuring out your strategy. And that means, am I going to be a pre-seed investor? Am I authentic if I'm a Series A investor? If you're a Series A investor, right, like, can you raise that much money? Do you know how to lead investments? Right? Do you have the team and the resources to do that level of diligence, right? And understand kind of the attributes of a company that are relevant for Series A versus pre-seed, right? The pre-seed bet is more on like team and market, and the Series A bet is probably more on like numbers and really understanding kind of like how this company is functioning and is it at an inflection point here to really like, drive up scale. So again, like I think, in the beginning, it's really hard to determine fund size, but you should have at least a theory around what you want to be. Another way to think about that is, what amount do you need to make it sustainable? And if you can't hit that target, right, that might be 5 million, that might be 25 million. Like if you can't hit that number from your network and from a fundraising process that most likely is going to last 12 to 24 months, then I would think about, making it a core part of what you do, but also thinking of other ways in which you can like survive in the market as an emerging manager until you can get to that, point of criticality, that kind of inflection point where you can become an investment manager full time because it's self-sustaining. The investment business is self-sustaining.
So fund strategy is always said to be connected to the fund size. So fund size is your fund strategy.
I think that's true 95% of the time. So I know that's like the common knowledge in venture. Like your fund size is your strategy. Like that's definitely a quote that comes up a bunch. I haven't always seen that, right? So being slightly contrarian here, but I've seen $30-40 million funds. Like if you were to say fund size is your strategy, like you would expect a $30 million fund to be a pre-seed seed stage fund. But I've seen $30-40 million growth stage funds, right? Or $30-40 million super late stage pre-IPO secondary funds, right? So I think for the most part, like that is a true statement. But again, like where is the advantage for you personally if you're going to start a fund? And maybe another way to think about it, right, is what's the gap in the market, right? So if you take a US perspective, right, I'm sitting in the US right now. If you take a US perspective, how many seed funds have been started in the last 5 years? Thousands. And so if you think about those funds raising, like just a big macro perspective here, if you think of those thousands of funds, many of them have been successful, right? Especially the 2020, 2021 fundraising environment, lots of distributions, lots of activity from the LP side, lots of fund formation. So all of a sudden you have this, ballooning in the ecosystem of hundreds, if not thousands of funds. And they're investing into pre-seed and seed stage companies, right? So it has to flow through the ecosystem. Fast forward 12, 24, 36 months, those companies that have been initially financed by those seed stage managers have to raise their next round, right? So what does that mean from like if you're a new fund manager, what does that mean for what the market opportunity is, right? Like you could approach it as like, hey, other people have raised successfully a series seed fund, so I should raise a series seed fund, right? Because that's what everyone else is doing. But maybe an approach would be like, well, actually, my background is more suited for helping companies scale, right? And yes, I've angel invested. Yes, I've worked with companies early, but like my skill set is helping companies scale, right? And maybe I worked for 2 companies prior on the growth side, and both of those companies were very successful outcomes. And looking at the market on a macro perspective, maybe the opportunity is this Series A crunch that's like impending or coming up. And it's happening right now because there's thousands of companies that are early stage that have been financed, right? They're all trying to figure out product market fit, right? And kind of, elbow and wedge their way into these markets and become category leaders. So maybe that's another way to like think about it. Like don't kind of look around, see like what is everyone else doing, but take kind of a more, macro top down, what does the market need right now in terms of financing? And that could be different for different markets, like all over the globe, right? That might be later stage, that might be earlier stage, that might be mid stage, that might be not only equity, it might be debt, right? So there's different ways to think about starting a fund and kind of you fitting into a gap in the market that's relevant for you and relevant for the market. And, maybe that makes fundraising easier.
You have seen many funds. What materials and preparation are critical before going out to raise?
Yeah, so last year, 2023, Coolwater met with 1,010 qualified funds. That's qualified. So that's kind of our perspective. Again, taking a step back, we've helped now launch over 200 funds, and they've invested into over 5,000 companies. So we've seen a lot of, I guess, reps on this side of like and most of those funds have been, again, successful raising their first, second, third funds. And so my perspective comes from, I guess, that experience. The question is, what do emerging managers need in terms of materials before they go to market? The simplest answer is, again, to what I was just saying, have a perspective on why you're different, have a really strong understanding of what your strategy is going to be. Ideally, that's built on something you've already done. It's already built on your authentic experiences, and putting that together into a strong narrative that makes it into your pitch deck, right? And I would start there, right? I would treat it very simply to start. Like if you're aspiring, again, I could go on for hours about like everything you could build, but just start somewhere and start iterating, right? With conversations from friends, smart friends in the ecosystem that would have a perspective on, is this fund product a strong product, right? Is your go-to-market motion the right one, right? To actually be successful. Like talk to people that are knowledgeable about the market, right? Have been doing this for 10 or 20 years or more, right? And can kind of give you perspective on, yes, this is a good idea, or this idea is a good idea, but needs to be strengthened a little bit before it's ready for prime time. So again, I would keep it simple to start. And another piece of advice is like, make sure your track record is understandable, right? Make sure people can understand what you have invested into, because a lot of LPs need that. They can't invest into a first-time investor. They can invest into a first-time fund, but they can't invest into people that haven't invested before. So the more organized you can make your track record, that list of your investments you've made over the last year, 5 years, 20 years, the easier your fundraising process is going to be.
How long should emerging managers expect the fundraising process to take?
It depends. Like, where are you in the journey? Generally, ballpark in this market environment, 18 to 24 months. Like, most people are going to max out the allotted time. Most smart emerging managers I talk to budget themselves 2 years to raise their first fund. Maybe that goes down. And then the reason that goes down is largely just because of your performance, or how well you can articulate, your advantage, your competitive advantage, or your differentiation. So the better your performance is over time, the more that number can go down. But if you're an aspiring fund manager going out with a new fund or even a second fund in this market, I would give yourself 18 to 24 months and just make sure you're budgeting properly, and setting the expectation properly. Because, if you're 3 or 5 months in to a process and you've set the expectation that you're going to close this in 3 to 6 months, right? Isn't the key to happiness low expectations? So lower your expectations and you'll find happiness faster, and maybe you'll persist to get to that first close and eventually that final close.
Once the fund is raised, closed, what are the most critical things? The GPs need to get right initially, setting up the back office and operations.
Well, they should definitely go through the Coolwater program to understand all the details there. But raising the fund it's hard, but it's not the point of the exercise, right? Like, the point of the exercise is finding great investments. And so I think once you close the capital, let's say final close, you need to set up a strong foundation for your fund. And there's, a whole nother pod on just like what that looks like. But that's not only setting up operations, but understanding how to manage those operations, and largely, understanding what should be insourced and what should be outsourced, and understanding all the pieces that will need to be managed over time, right? And I think the big picture concept here is setting it up so that it's cost effective, it's efficient, you can run it, right? Because you're going to be the one running it usually. especially if you're a solo GP. And another big concept is, making sure you don't have to necessarily rip and replace or completely like upend your full back office by the time it comes to fund 2 or fund 3, right? And I think that requires some knowledge and foresight, where I see that happen a lot, where emerging managers are spending too much time on operations because they haven't thoughtfully structured the business to scale. And I know that's a debatable point, where some people be like, well, you just got to get it done like to start, but spend the extra hour, spend the extra day building the process correctly in the beginning, and you'll save tens of hours in the future, if not more.
How does the operational setup differ from the solo GP versus the large teams then?
Yeah, I've written some public articles on this. Not too much, right? I think as a solo GP, it's harder. There's just fewer hours combined across the team. But I don't think like all the functional parts of what you need to do, banking, fund admin, accounting, tax, like all of these things are going to be functions, whether you're one person or whether you're 10 people, you're going to have to do all of them. So as a solo GP, I would think about just efficiency and again, cost effectiveness, right? If you get too bogged down into trying to become too institutional too soon, I do think that will like hurt your journey and kind of drag you down and make you less efficient. I think you should be thinking about like, what's the leanest operation I can run that, sets up my business processes super strongly and efficiently, and like it works for me, right? And ideally, like you can build those so that you can scale and train other people very quickly. Like if you add a second person or, my second book, the big thesis there is, as a solo GP, you should hire someone to help you run your back office sooner rather than later. Because,
so what is the most common roles and capabilities fund need from the day one?
The fund manager or the operations person?
I mean, the GP.
Yeah, I'd say the reality is like you probably can't afford anyone in the beginning. So that should be the expectation. So you'd have to like figure it out for yourself. But the way I think about it, the way Coolwater thinks about it, right? Like what generates alpha? You picking investments well, right? Like you having a strong decision-making framework and investment process. Fundraising doesn't generate alpha, right? Operational alpha is a concept, right? But what it does is it makes you more efficient to make better investment decisions, right? And it allows you to learn on the back of your decisions. So it's effectively part of your decision-making framework, right? And that is what investing is, right? It's the heuristics and learning and experience and pattern recognition over time, all coming together to make better and better decisions, right? So that's how I would, that's how I think about it, is like you won't have anyone. So if you need to focus on like one thing, focus on investing well, right? Because nothing else is going to matter over time if you don't invest well. But then if you get that, right, and you feel like, you're dusting off your shoulders and you feel like there's some cycles of time to focus on other things, then I would think about setting up the business with respect to this concept of operational alpha, like build better operations, build better management so that like you can be more efficient as an investor, right? And then, who do you hire as the first person? That's a decision that differs across different emerging managers. Some people will want an investment support person, right? Completely. Some people will want that person like split. So they're supporting investments, but they're also supporting operations. Some people even choose just to do operations, right? They're more of like a chief of staff. The solo GP is more like the front office doing all the investments. And this person is supporting everything else as like the interface for everything else. So it really depends. Like, again, like I said, I meet with over 1,000 managers a year. I work with hundreds. So like my perspective is broader. It really depends on like what's right for you, and what's going to make you a better investor. And that differs depending on the person.
What tools or systems should be implemented right away? And does it differ from domiciles, different domiciles?
Yeah, I do think there's an 80-20 here or a 90-10. Like 80% of the stuff is going to be similar across jurisdictions, right? So that's probably the first framework I think about it from. So I need to set up a CRM. That CRM needs to track my data. I have deal data and I have LP data. Is that going to change across jurisdictions? No. But maybe something to think about is, are there regulatory restrictions on what data you can track and how that's protected and how that's managed? Like the answer is like, yes, like your jurisdiction could matter, right? So I think, are you going to be obsessing over that as an emerging manager? Probably not. But as you scale up, right? Like, do you have, personally identifiable information on people, right? Like that might, and the answer is yes, right? You have LPs, there's a lot of sensitive data there, like who's managing that data. So again, everyone sets up kind of data infrastructure, but the concepts of like, what you need to manage, how you need to manage it, what your security is, right? Like you might want to be a little bit more focused on security and your IT compliance if you're in a place that, right, like you could get punished by not managing data well. I think that's like something to think about. So the 80 is the CRM, I'm setting up my data. The 20 is okay, like in my regulatory framework, right? Like what do I need to adjust in order to be in compliance with me as a fund manager in this jurisdiction. Other things, again, they're part of the 80, right? Like this is my point on like insourcing versus outsourcing. Like what are the pieces you need to insource today? I would argue the landscape has completely shifted in the last 15 plus years, where it's very strange for an emerging manager not to have a third party fund administrator, right? Where 20 plus years ago, that was probably de facto, like you just did it internally, right? But I think there's these bigger shifts that, right? Like if you grow up in this generation of emerging manager, you don't even realize like the market has changed. Like you just assume like this is the truth and it's always been this way. So I would think about that, like, double down. What do I need to set up? Again, like what's the point of being an emerging manager? Let's not lose the point. It's like make good investments. So what do you need to set up? What do you need to insource? What do you need to outsource in order to do that well? And again, I think it's kind of the core, right? You need to have a bank account. The money's got to flow somewhere. You've got to have controls around that. You've got to have a fund admin, right? Like you're going to be making investments and someone needs to manage that financial data. Like most likely you're going to have to pay taxes. I think it's hard to escape that one. And then, yeah, I mean, like those are largely the fundamentals, right? Like when you're setting up, and we can go into the 201 and the 301, but the 101 is largely like, those as the major functions.
You have seen more than 1,000 funds. What are the common mistakes do new managers make in the early stage of executing on their investment strategy? How can they avoid these pitfalls?
Yeah, for fundraising
and setting up fund and investing. Also exiting, exiting the startups.
Oh boy, exiting. Well, we've already gotten an A if we're thinking about exiting on an emerging manager podcast. So, I'll cover the three. So, like I said, for fundraising, I think it is thinking about what I said earlier, which was having the right materials and stories in place when you go to market. And I think that does mean that pre-marketing phase that intentional part of the fundraising process where you're iterating and learning and adjusting, right? So you can have a much stronger kind of fundraising process, like thinking about it that way. Like if you don't spend enough time there, then you kind of trip up as that first part of the fundraising process. So it's a very nuanced point, but it's like a Kickstarter campaign where you've raised 80% of the funding before you even like announce it to the public, right? You're like, look at how successful I am already, right? And everyone's like, wow, this thing's so successful. And like the last 20% comes in, right? And then like you oversubscribe because, it's already been so successful behind the scenes. Like that's the pre-marketing phase, right? So as an emerging manager, like I would think about just, yeah, like making sure it's, it's a very strong positioning before you actually run the full process. And the full process of fundraising is like all consuming. On the ops side, yeah, I just give one kind of quick piece of advice, but like I mentioned, you set up banking, there's going to be compliance, right? Just set up the right cash controls. And go through a program like Coolwater or read my book or talk to friends that have like done this before. Like there are a lot of common mistakes. It's hard to capture them in a single podcast without being overwhelming. But on the ops side, right, like you want to make sure you have the fundamentals set up so that you're not making mistakes and so that you can scale. Like those are the key points. And then on the investing side, what are the mistakes that people make? It's venture, right? So doesn't 90% of the portfolio fail? You're almost guaranteed to make mistakes on the investing side. So again, like if there's a piece of advice, it's set up the right investment process and set up the right decision-making framework, right? Like you're probably going to fail at something, but maybe your process isn't a failure, right? Right process, but the company just doesn't like the outcome, wrong outcome. So I think about it that way. I think some of the best investors probably think about it that way, right? And if you set up that system and that structure, you're setting up for better probability of success, which in my mind is what a lot of venture is.
So what is the right pace for deploying the capital and making the investments?
In 2021 or 2024? In 2021, the answer is 6 months. In 2024, it's a little bit longer. Yeah, the right pace, I would argue that the right pace is like the pace at which you see the best deals. So maybe it is 6 months, right? If you have the best deal flow in the world, why can't you invest in a year, right? I think the argument against it would be, vintage diversification, time diversification. You also, your fundraising skills are the complement to your deployment pace, meaning if you invest really quickly, then you have to fundraise again really quickly, right? And is the performance there to kind of, and the brand building, is that there? And are the relationships like strengthened? Like, are those there in order for you to like raise your second and third and fourth fund? So if you deploy in a year, it's going to be harder without like super strong relationships to raise your next fund. But maybe you're amazing and like all of your companies got marked up within that year as well. So then it'd be like less hard to raise your next fund. So again, like why do funds, or why did like funds take 3 to 4 years? I think it was because the quality, you have to have deal flow. You have to sort through that deal flow to pick quality. You have to allow some time for that, deal flow that you've invested into to mature. So there's actually performance to raise your next fund, right? Like if an LP can't bet on what you've actually done and how those companies actually are doing, it's very hard to kind of get to your next fund. Maybe the same people end up doubling down because they just know you and they trust you and they're betting on you. But if you want to bring in third-party LPs that you've never met before, like they do need some like outside perspective and track record, right? And so I think that's a really key point.
So you mentioned about also deal sourcing. How should be the due diligence and deal sourcing be structured then for the VCs?
This is one of the key things I'd imagine LPs are betting on, right? Is what is your network and what is your access to that network? So if you're spinning out of a tier one technology company and you're running the engineering team, right? Like there's less of a leap of faith required by the LP to believe that like, oh, this is a well-respected head of engineering that has access to all the cool projects leading this tier one, tech company. Can that person like get really good deal flow with like incredible technical talent that has already proven like they can build like really good projects like internally? So the leap of faith would be like, can these people like does that person have the respect of the engineering talent? Is that person setting up a system to like track all that stuff and like engage with that talent at the right time? Like, that comes with like social capital as well. And then, yeah, is that person like a good picker on this stuff, right? Was it other people picking at the tier one tech company, or is it this person the picker of like great stuff, right? So there is still leap of faith there from the LP's like investment decision. But it's like probably like if you can get over those things, like you can probably make the bet that this person's going to have like great deal flow, and that's going to be their deal flow, and that's going to be their angle, right? I think you have to have a brand or an angle for deal flow, right? And so everyone can get deal flow. It's just a matter of like how good the deal flow is, right? So I think in terms of sourcing, the mechanics look the same, right? Everyone's like, look, I've got a CRM, I've got a bunch of deals, but the quality differs, right? How good are these teams? How good is your deal flow? How systematic is it? And then to the systematic point, like how systematic over time, meaning like, is your deal flow constantly growing and improving, right? And the goal should be for every emerging manager to have the best deal flow in the world, right? And it feels like a lot of behavior would indicate that people just think their deal flow is fine, like it's good enough. I think you have to like have the mentality of it's not good enough. How can it be better, right? Like, what am I doing wrong? What are the relationships I need to establish to get better deal flow? What's the brand I need to build to get better deal flow? What are the skill sets I need to acquire to get better deal flow and to partner with stronger teams, right? And I don't think there's like, to your exit question earlier, like, I don't think there's enough conversation around that, right? Where it's like, look, I've done this, even the example I just gave of like spinning out of the tier one tech company. It's like, great. Now you're 5 years out of the tech company. Why are you relevant anymore? Right? There's 400 people that have like led the engineering team since you, like they're all spinning out and starting venture firms as well. Like, and they're all going to like, why aren't they in like pole position now to get the tech talent from that tier one company? So again, like, it's like, well, because I built XYZ systems and brought on ABC people onto the team, right? And strengthened the brand, and people know us now, and like, look at our track record, all these other things that I've done, right? Kind of gives you the right to defend your position, right? But you don't just like get it, you have to kind of earn it. I think deal flow is earned. It's not gotten.
When should the managers start thinking about the exits and follow-on rounds?
Back to the exits. I love it. Yeah, it's hard for me to answer the exits question. I think that's a conversation between the GP and the founder, and kind of the founder's willingness to persist, and kind of like, it's weighing the options of, yeah, if there is kind of an option on the table to exit, right? Like, how well is the company doing? What's the product market fit? How long can this go? Right? There's a lot of like nuance to an exit, I think. So that feels more of like a personal conversation than something I can comment on well. The follow-on question, when is the right time for follow-on? Again, like, I think maybe the way to think about this, like taking a step back, the way to think about follow-ons is, it starts with portfolio construction, like you having at least an opinion on like how your follow-ons will work. And I think a couple of years ago, some follow-on strategies were defenestrated, they're thrown out the window. In today's market, it feels like follow-on strategies are back, right? Like doubling down, shoring up companies' balance sheets, protecting your ownership, betting on kind of your quote unquote winners in the portfolio. Like it feels like follow-on investing is back in vogue. But I think, yeah, you need to, I think maybe the way to think about it as an emerging manager is like, are you in a position to make a good decision, right? It comes back to decision-making frameworks. So I made a decision once thinking that this was a rock star team and a high potential product in a gangbusters market, right? When it comes to that follow-on decision, do you have, the right information channel set up? Do you have strong relationship with the founder? Do you have a renewed or matured perspective on this company and like how it's doing, right? And is that enough information for you to make a strong, again, higher probability of success decision on, doubling down and investing into this company? I think that's how I would think about follow-ons. And as an emerging manager, like if you can answer like, yes, I am in a better position to make a better decision, a more informed decision now than I was, X months ago, that's a good place to be in.
So how involved should VCs with their portfolio companies after post-investment? What values added to, especially to the founders? What is the optimal level of engagement with the portfolio companies?
This is a respective question. So it's up to the emerging managers. You don't need a value add strategy as an investor, right? So the framework there is, I'm a stock picker in the public markets. Do you need to add value to the companies to be a good stock picker? No, right? You could do the same thing in the private markets. So again, like if it's relevant for your strategy and building your company and building your brand, building your relationships with founders, getting better deal flow in the future, like, helping inform better investment decisions like in the future, then maybe you do choose that as part of your strategy, but it's not necessary.
What innovations in VC industry, VC fund structures, terms, and models do you expect to see more of in the coming years?
Yeah, I think we've seen some of it. I won't comment on the rolling funds. I think the market has demonstrated that close-ended private funds, at least for now, at least from what I'm seeing, seem to be still in vogue, but that could definitely change. I think, innovations maybe it is like this, never-ending quest to try to make VC firms technology companies. I haven't seen a lot of, again, like recent innovations. Like there's definitely an unbundling going on, right? There's a lot of software being built to focus on like specific features or tasks across like being a VC. Innovations, I haven't seen a lot in the last 12 months, kind of thinking like definitely going back 5 years, like you've seen market changes, right? More secondary opportunities, more seeding opportunities. You mentioned the rolling funds, other structures. The concept of, SPVs is a little bit longer, but like that is like an augmentation to an investment strategy. Like that's almost just commonly accepted now that that's going to be part of your strategy from the big funds and from the small funds. But I haven't seen a ton of innovation. Like there's definitely technology development going on and people trying to make the investment firm more efficient. And, there's models out there, right, where people, co-invest systematically, or they, do other things to try to, I think, approach the power law dynamics of venture capital and optimize based on that. But I haven't seen just like a net new, killer company that's come out in the last like 12 months or so.
Should you tell about the Coolwater program, especially new managers?
Yeah, so we have a couple of programs. So if you're looking to build your track record and strengthen your track record, right, we have a program for that. That's called Explore. Again, I think the reason we built that is it's very hard to raise capital and be a fund manager if you don't have a track record and, more likely a strong track record. And so you're exploring whether or not you want to be a fund manager. And then the core program, we call it build, like you're ready to build your fund. And so that's the one that's helped launch over 200 funds in the last few years. Again, we'll focus on fundraising, operations, and management. So we're looking for good investors at that point all across the globe. But if you're a good investor, right, we want to talk to you and help you set up your fund, set it up to manage well, help you get that fund off the ground. And then again, once that fund is off the ground, I'll mention a third program we have, which is we'll build your back office for you, because it's not obvious. And there's a gap in the market for really understanding how to build and coordinate a back office. So we've built that to, again, help emerging managers solve what will inevitably be a large headache and a large commitment of time and probably a suboptimal build. So with us having, I've invested in over 100 managers. Coolwater's helped launch over 200 funds. We have a lot of kind of expertise in building and running funds and understanding like how that should be built to be very efficient. So again, like you can come into any of those programs, but that's how we've tried to build it. It's like, what's the gap in the market? Let us try to build something that supports emerging managers.
Winter, what resources would you recommend for the new VCs to learn proper fund administration and processes? How can they get up to speed quickly? Of course, your two books are very resourceful and also will be the first kinds of books to be read. But what are the other resources?
Yeah, I'm biased. It's really go through the Coolwater programs. I don't know anyone else on earth that's worked with more emerging managers in a robust way. And we feel like it's just tip of the iceberg. We're always learning. But yeah, the two books, How to Raise a Venture Capital Fund, How to Set Up a Venture Capital Fund, are good resources, but no one's really doing that. No one's really doing that training other than Coolwater from what I can see in the market. So like if you care about this stuff, that's a big if, right? Like, but if you care about this stuff and wanting to build a strong firm and an institutional firm and you want to scale up and you want to do this as your full-time career and job, like, this is why I've built Coolwater, to help those people that want to do this full-time and scale up and, be the next Sequoias of the world and Andreessens of the world and like be the next big thing, the next big fund.
Winter, I really appreciate you taking time to share your knowledge and also insights. And thank you for joining us and also sharing your wisdom. It has been really a pleasure for me to have you on the podcast.
Rock, thank you. Yeah, hopefully it's educational for the listeners out there. Thanks, everyone.